Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
And here we are at the end of another week, which I would define as complicated, as expected. Markets still trying to figure out what's going on with the war and the geopolitical tensions. Of course, you don't need me to tell you what's going on. But beside that, as for what we've seen, it looks like we are transitioning, as again, it would have been expected from day one. You know, some things they can last just for so long. We are transitioning from a NACHO situation to a NACHO situation. And I'm going to explain that later on. But first of all, it's not mine. I didn't come up with a joke. I just read it on the internet, all right? But, I mean, if you follow social media a little bit, you already know what I'm talking about, all right? Other than that, we got a few data points as for the economic calendar coming out this week. Nothing really super relevant for now, at least the way I see it. But we got the composite PMI, which again, it was the global PMI. So my favorite would be ISM, but we are gonna have them, I guess, next week, maybe, but I don't really remember now. But again, I'm more keen to ISM rather than the global. But nonetheless, we've seen the data coming up above the 50, which again should be positive, all right? But, by the same token, you could say that you're now seeing a decline, right? And if you dig in sector per sector, you see manufacturing holding up relatively better compared to the services part of the data. Now, one thing, first of all, you might say, well, one is doing particularly great. The other, still in expansion territory, but slowing down a bit. The thing is, if you think about how they are weighted in, the domestic economy, what you know is that services, they count more than manufacturing. So, if services goes down, I would take it as a negative, even if this one is staying positive. Plus, when you look about this one alone, manufacturing, we already seen something like it. I'm not saying it's going to be the same, but think about these. When we got the tariffs, right, what you've seen was a lot of tariffs front run. And, it might be the same right now. If you think that because of the oil spike, the energy spike, what you need to buy is going to be much more expensive into the future, well, you might just as well buy it now so that you fill up your inventories so that when you need those, it could be input costs, it could be raw materials, whatever, you can make sure you have them, right, for the time where you need them, and you won't have to scramble into a market which is getting more and more volatile with prices, more and more expensive. So I think there could be a little bit of that phenomenon in there, but again, it's not something that I can confirm just looking at this number as it is, right? Just a thought, all right? Now, moving on, what we got was initial jobless claims, which at this point for me, it's not really relevant, especially because we are going to look at what NFP and, the usual unemployment rate, participation rate, average hourly earnings next week on Friday. So I think for the market, this one would be much more interesting than just looking at the jobless claims at this point. And finally, we got the University of Michigan consumer sentiment, which, of course, if you look at the last 10 years, as we've noticed, it's trending down like a lot. So, consumers, are they feeling particularly optimistic? No. And for all the reasons, right? Wages not keeping up. Savings rate are being depleted in a very significant way. So, it's natural to see something like it. Look, at the end of the day, I think whatever economic data will come up in this period, unless it is, of course, inflation or something related to the labor market, all the rest, we are all trading the same thing. We are all trading oil at the very end of the day. It doesn't matter whether you trade metals, whether you trade a stock index or a single stock. To some degree or another, you are trading the inverse of what is going on in oil. Oil goes up, all the rest goes down, except maybe for the DXY. But, that's the theme now. Oil drops, it pulls back, everything sees some sort of a relief rally. All right. So, unfortunately, right, whether you like it or not, for better or worse, this is what we are seeing right now. And to be fair, at this point, I don't feel like it's gonna come to a resolution anytime soon. But again, a man can hope, right? As for the rest, we've seen break-evens dropping down a notch this week. But again, if you just look at what the current trend might be, you could still categorize it as a higher highs, higher lows. So the trend is up. Inflation expectations are going up, obviously, because energy is the most impactful factor when it comes down to inflation's expectations, because it is reflected all across the supply chain, as we well know at this point. You need energy to do whatever, right? So obviously. Now, trueflation, as for the headline CPI, ticking up, still around 1.80, with the headline being at 2.4. So we see how these data shapes itself out. Especially, I would like to see what's going to happen with the next headline reported by the BLS, CPI print. That might be telling, I guess. And PCE instead, it's, I guess it's much more in line with what the official data are telling. So, still, it looks like we tried to drop and we came all the way back down into what you could consider as, the midpoint of the range, or the fair value, whatever. But, obviously it is influenced by what's going on across the globe right now. As for the rest, you see that no one it's pricing cuts anymore. And again, actually, they are leaving the doors open for potentially a hike. Again, to some degree, I hope. On the other side, I don't think, especially with the historical precedents, that the Fed will be so dumb to actually thinking about hiking rates. I mean, sure, you can do it if you think it's gonna serve a purpose, right? Do we need to work on expectations? So if we show ourselves as hawkish, the market might think, oh, well, look, they're doing something, therefore maybe inflation won't be as dramatic as everyone is expecting now. Sure. But I don't think the market is that stupid. And it might be, look, whether the Fed is moving rates or not, does it really matter? If the Fed hikes or cuts, how does impact the Strait of Hormuz being open or closed, or the flow of oils, all those barrels of oil being delivered where they should be delivered? The Fed cannot impact that, so who cares? And even if they know they can't, and they do it anyway, they are gonna cause the damage, which would be even worse than what it really is. So I think the market would take it negatively, obviously, but not because it's not accommodative. There is not enough liquidity. Sure, the liquidity problem is already manifested. I just think the market will really take it as, oh shit, they don't know what they're doing. They're playing the same playbook again. They're making the same mistakes the ECB did in 07, 08. So yeah, you know what? Let's get out of the way. So I really hope the Fed won't cut, and they just do what they always do. Nothing up until the point something really big happened, right? GDP now, it's giving us 2% for Q1 of 2026. And again, I still think final revisions for 2025 will be around this 2%. As for credit spreads, what we are looking at, they came up a bit, and then recently they pulled back, I think, ever so slightly though, so not a lot. Still, a little bit of stress is still signaled, it's still present with all that's going on in the private credit, private equity, whatever you I think, again, we have been discussing that. It's not as bad as it was in '08, but nonetheless, it could cause some stress, right? Especially, because these are things which more often than not are priced by the simple perception. So it's hard to really define whether the risk is systemic or not, right? So that would be it for the economic calendar and the introductory part. And let's jump into some charts. And as usual, charts, DXY first. It looks like we held that retest, we got the move up, expansion to the upside, drawing back the leg, and we held that tiny little shelf that we were building up on the way up. So another push to the upside. We'll see if we can actually break out of these highs and starting to think about targets in the 101 region, right? So 100, 101 and 300, 400, basically these old high right here in that region. Might be a bit higher, it might be a bit lower, but again, that would be kind of the region if we can break out and keep on maintaining this bullish posture. Otherwise, I don't think, even if we don't break the highs cleanly, right? But, at the very least, I think we are going to be boxed in this area, right? If it's not completely bullish, I think we are going to ping pong around in here for a while. But I don't see the DXY in this situation getting back down, below 90, 98, 97, right? So for now, I would maintain a bit of a bullish bias on the DXY for all the reasons we already discussed, right? Which, obviously, looking at the other currencies, it puts them in a very precarious situation. Now, the euro, as you can see, it had that tiny little bounce, and it looks like it was faded, at least for now. We still have this low, which wasn't taken previously, but at this point, I think, again, the odds of seeing the euro back below 114 are increasing by the day. Now, once you start to violate 115, yeah, sure, you got your reflexive bounce, but again, if the situation is not normalizing overall, I think with a stronger dollar, obviously, all the rest it's going to suffer. And, if you just look at the British pound, it's kind of the same. It's going down for now, slowly, orderly, but as you can see, it's starting to break support and confirming them as resistance and tapping in the lower supports, which, in time, if you keep on doing that, they're going to be depleted and they're going to give in. So, it's always the same. The Japanese yen, it broke back below the, recent lows, which were put in at the beginning of January 2026. And again, we are back to 160. So, see that? I mean, sure, you might say, well, would have never happened if it wasn't for the Iranian crisis. Is it? Because I've been thinking this thing is going to go to 200, and I've been saying it for months. So, yeah, sure. Do you need a catalyst for some very sharp and sudden move? Yeah, but I mean, look at the trend, right? It's hard to argue against it and saying, well, no, actually, it is bullish. Sure. I mean, at this point, I would really question your definition of bullish, right? Now, as for the others, dollar Canadian, again, we were looking at an apex base, which last week, it was looking like it was broken because we closed, I guess, kind of around here, right? Yeah, that was it. We broke down. We were tested back into it. As you can see, on Sunday open, we spiked back into the old apex base, and then down we went for all the rest of the week. Same thing to the Swiss franc, which was a bit ahead of times, right? Basically, what you've seen in the loonie, it's what you've seen in the Swiss franc a week or 2 weeks, ahead of times. So it's basically the same behavior all over again. And even if you check other currencies, for instance, what you can see now, it's the same in the South African rand. Now, I added this diagonal just to highlight the momentum. I don't necessarily trade or like diagonals, but sometimes if you want to identify the momentum of something, just look at that. And you might say, here is where the flows actually shifted. But I do prefer horizontals on a regular base. As you can see, we break this level, last low in control of the push-up, came back down into it, back up into it, and down we went. The Russian ruble, again, had this huge rally. I mean, it was a bounce, not really a rally, but it looks like it hit resistance where at previous support, obviously, right? So same dynamic that we were looking at in the South African rand, it might be at play in the Australian dollar. As you can see, it's basically the same playbook. We'll see if it confirms to be exactly the same. Do we have a pullback back into the old base and then a sharp move down, or we just go down, straightforward if the DXY shows another very bullish week? That's remained to be seen. Indian rupee, what are we talking about, right? Look at that. The market which never bounces, right? So again, very tough times for the Indians out there. And, the only one which is holding up relatively well compared to all the rest, obviously, it's the Brazilian real, which is still above this, long-term consolidation in here. And, although, again, every single push down, it's depleting the support, for now, it's still holding. I think, again, if things stay like they are right now, or, God forbid, they worsen, at a point, even this one will break down. But for now, if you just run some sort of a relative strength analysis, you might see that throughout all the currencies we usually look at, the Brazilian real, it's most likely the stronger one for now, right? Now let's have a look instead at Bitcoin, which, my oh my, do you remember being neutral on this asset was the right thing to do? Because what? Because I'd never seen a risk-on assets performing particularly well in a risk-off environment. So I was expecting to tap into this level, to be quite honest. We didn't. We came back down, another tiny bounce. If you look at this bounce, it looks like, if you zoom in on the 4-hour, for instance, what you see, the run up, then we broke again. We broke the floor here. So this is where the last impulse to the upside was originated from, right? And yeah, after we break back down below it, every single tap back into it was seen and treated as resistance. And then we went down further. Now, sure, at the end of the day, we are still in this massive range. We cannot break out to the upside. And at the same time, we didn't yet broke down. But, if you, me in this case, if we, let's use we, isn't it neutral, right? It's like all my discussion with Penny are always, we, they, me. You gotta love pronouns, right? But if we were looking at this trend line and identifying these as some sort of an ascending triangle, right? At this point, it looks like, again, we broke the trend in here. We broke the flow. So if you want to still maintain a little bit of a bullish bias, or if you want to figure out the best case scenario for now, I would say keep on going sideways. Although, again, I think I would be a bit more bearish than that because, being neutral was right up until the point it was going up. You just don't bet on a huge run up and potentially on a consolidation which keeps going. And now I see it breaking down this momentum to the upside. The structure starts to give in. And I'm looking at other markets like, the stock market starting to crack. Do I really want to be even neutral Bitcoin? Sure. Can it bounce? Yeah, absolutely. You can see a bounce from here. It bounced in here. It bounced in here. Can you see another tiny bounce? Possibly. But, even in here, you see a bounce, and then what? So, every single bounce, this one, now this tiny one, everything was faded at the end of the day. So I don't have a lot of hopes for Bitcoin at the current moment in time. I think, the question would be legit. Where do you think it would go if we really break and cracks below this consolidation? I mean, mid 50s, high 50s, right? Kind of like in here, right? 57, 58 to start out. And then we'll see if we can establish a low there. But, I mean, quite honestly, I think low 50s at the end of the day. Because, look at this consolidation here. We tapped into it, used it as a launch pad. We are now back, basically, in it. Yeah, I mean, offered up a little bit of support. But, overall, if all these things give in, I think sooner or later you'll see the other side of it, which would be, again, in the low 50s. So, sure, many different things could happen in between here and the next month or 2 months. But, if I had to bet, gun at my hand, I would say I see, mid 50s, low 50s, coming before mid 80s, right? As for now. Then again, do we see something drastically change? Like the conflict in the Middle East is resolved, we will get back to a risk-on scenario, and we start to see these tiny piece of tech doing something like this and starting breaking highs and maintaining them and then pushing again. All right, then obviously I will shift my bias. But looking at these now, I would say for now need to be bearish. Let's have a look instead at gold. Yeah, I mean, we got that move down. Gold closed where? Last time we were looking at it, yeah, it was in here. So, another push down. I was thinking, quite honestly, 4,000, I think I said 200 maybe, or 250. Well, but again, I was looking at this region, which again was traded through. Yeah, sure, offered a bounce. Overall, kind of like Bitcoin, right? If you think of, going back in time and looking at all these volumes built up in here, this, can call it a base if you wish, which originates the run up. We tested back into it before actually getting parabolic. So in here, then we got the first liquidation, bounce, no new highs, failure, and then very sharp move down. Now, the thing is, up until the point this one doesn't completely break, I can't be, uber bearish gold and saying, you know what, this thing is going to go back below 4K in the mid 3000s. I think up until the point we hold above 4,000, big figure, there is still the chance that we can kind of try to establish a new dealing range while we wait for the conflicts to be resolved. And again, quite honestly, I think if the conflict is resolved, gold might resume its uptrend, right? But given the situation now, and given the fact that I do think there are things which, whether you believe it or not, are worth more than gold and are worth having more than gold, aka the dollars that you need to buy oil, gas, and energy at a higher price, because at the end of the day, gold is all fancy and dandy, but can you put gold in your tank? Or can you put gold on the table if you are starving? No. So what's going to happen? It's one of those situations where in a period where you think there is going to be a crisis, or the crisis is already happening, you don't necessarily sell what you want, but you need to sell what you can. And if you need to raise cash, what's better to be sold than something which was going parabolic like this, where pretty much, at least at this stage, right, kinda, right, everyone, whoever bought it over the last 24 months, they were all massively in profits. So if you need to raise cash, where can you actually materialize or realize some profits? This might be one of them, right? So again, I'll think up until the point things keep on staying like they are, I wouldn't be so bullish gold. I think, right, there is still hope in here, maintaining this base right in here, right? I'm potentially waiting for the conflict to be resolved and things getting back to normal. At that point, you would get back to the same old narrative, right? Yeah, sure, inflation is no longer a problem, so the Fed will go back to thinking about cutting, right? Inflation will normalize, we are going to have even more liquidity, and therefore what? Well, if real rates will come back down, gold should appreciate. Because at the end of the day, all of this is still happening in a situation where the world is fragmenting, central banks keep on buying gold to diversify their reserves, so you will have a natural bid for gold. Yeah, potentially, yeah, I think, but is it going to be next week? Or who knows, in another 2 months? I don't know, right? If there's one thing which is clear at this point, is that the news are just manufactured and fabricated, and they're all fake. Both parties involved, I think, are trying to say what they want to say, and are trying to push the narrative which is conducive for their reasons, their logics, and potentially their ultimate victory in this conflict. So who would you want to trust? I mean, do I trust the Iran regime when it comes out with all these things? No. Would I trust President Trump? No, obviously. I mean, why would you? And again, it's not a judgment on the person or on the institution or on the country, on both sides. It's just a judgment on what is actually going on. Every single time you hear something being said and then completely negated 24 hours later. So, I guess it's really hard for markets to really price in what's going on. And sure, there might be someone out there which has access to real and privileged information, but it's not us. We are not. So we can just trade the chart. We can just trade the price we see, right? Now, looking at the others, pretty much it's kind of the same. Palladium, actually, taking it on the chain. Copper, well, at the end of the day, copper is holding up better than the rest, I would say. Although, don't really like this pattern, right? Running up, exhaustion, coming back to the lows, failing at new highs, breaking. Again, I think, I know I sound like a broken record, but look how many times you see this pattern, right? Run up, exhaustion, back down, trying for a continuation. No, staying in the range, getting weaker and softer around the lows up until the point you actually crack them. So, something like this, it's really the ABC of a top being put in. Now, is it going to be a short-term or a long-term top? I don't know, right? All I know is that for now, the risk, obviously, it is to the downside. So, for me, that's enough information to know what I would like to do or what I wouldn't like to do. Regardless, it is copper, it is a currency, it is an index, it doesn't matter. You can see these things on every single asset class you're going to look at, all right? So, silver, kind of the same. It's behaving much more like gold or palladium or platinum, but, there is weakness. And again, we are at what? 69, right? I like that. And, is it bullish? Is it bearish? To me, again, it looks bearish. Sure, same as gold. If everything is resolved, you might see it catching a bit, same as all the rest, but it's just, we have been looking about what's going to happen when these metals historically had these huge runs to the upside. The process of correction, it is usually painful first, and it's not so quick as many others would think. So again, I can't be bullish metals for now, especially because, we have been looking at something like this for silver, but even when you check gold, I mean, it's basically gold. If you check the standard deviations, right, how much, even if you don't like RSI, but look at how much is overbought and how much it should come down in order to correct that overbought conditions. And even if you think about a mean reversion to the long-term average, we are talking about a 60%, more or less, from the top. Now, you might say maybe it won't touch the actual, regression line, right? Maybe it will just came back down. It will come down, in the first standard deviation boundaries, and then from there, it's going to find its footing and push into the upside again. But maybe not. Another argument would be, well, the more it holds, the more, this long-term average has the time to catch up, and therefore making the pullback less painful. Sure, everything is on the card, but again, since I don't know the future, the only thing I can assess is the risk. And I've told you many, many times, what's the most powerful force in financial markets? I'm going to leave it blank because you already know, right? Let's have a look at yields instead. Still climbing to the upside. Friday was a little bit, there was a little bit of a divergence on a Friday. Yeah, I mean, the 2 years came down a little bit. The others, they kept on spiking to the upside. So is it a massive problem? Well, it's the same problem it was last week, I guess. And that makes, it puts pressure on. Again, I'm not saying this is me. I'm saying this is the narrative, right? It puts pressure on the government because it's going to be hard to refinance itself at higher rates. It's going to increase the burden of interest rates payment on the balance sheet of the state. Now it costs more than what? Social security, healthcare. I think it's rivaling with defense spending. I don't know, because you never know with defense spending. I mean, the Pentagon, how long has been since the Pentagon actually passed an audit? So, you never know there. But yeah, sure, they're spending a lot on interest payments or interest on the debt. But it is also true that I do think at a point you need to come to the realization that no matter how much bonds are dropping or yields are spiking, if you strip out maybe 2 or 3 auctions which weren't stellar and they were classified as bad, as for the rest, over the last 12, 18 months, there was a very good bid to cover ratio in all these treasury auctions, which translated, it means that the world still wants to buy the treasuries. And when you think about that, the more yields go up, the more it's enticing, considering how the rest is performing, would it be bad to park your money for now in something which would yield you a 4.2, 4.9% yearly with no risk, basically? If not, obviously, the risk of being stuck in it. But you don't have to go way farther the duration curve. You don't need to buy a 30-year government bond, right? You can park your money in short-term bonds, like 2 years, 5 years, 7 years, or even money market funds. It's not bad, right? So I think the more yields go up, the more they attract or they start to compete with other assets, considering the risk assessment of those, when you compare them with basically the free risk rate. So the fiscal cliff, the debt cliff, all the cliffs, I don't think they're going to be a problem anytime soon, right? Will it be painful? Will it be better to have lower rates, therefore the government can finance itself at lower rates? Sure, that would be way better for the government. will the government stop functioning, or will be, will we come to that situation where the government can actually fund itself, and all those treasury auctions looks like a desert with no bidders? Nah, don't think we're there. And again, don't think we're gonna get there anytime soon. And I'm talking years, right? So, don't believe everything you read in the headlines, all right? Because there are people which have been calling for something like this for 40, 50 years, and they're always been wrong. So, sure, you're gonna be right someday, but probably you're not gonna survive all the times you have been wrong in the meantime, right? So that would be it for the most part of what I wanted to look at. So look, since we are talking about yields, let's have a look at this, right? So I've talked about interest rate swap spreads in the past. Now we are talking about inflation swap rates. It's still a swap contract, so it's still function kind of the same. And again, it's a little bit complicated. It's a little bit technical, especially when you have, if you remember interest rate swap, one counterparty, it's committing to, pay a fixed and receive a float. Or on the other side, you might have the one which is one to receive a fix and pay the floating. So, what matters at the end of the day, it's not really how they function. But, without getting into the rabbit hole, but just look at the numbers. So if you look at 1 year inflation swap rates, they're trading about 3%, 3.1. But when you look at the 5, 10, 30 years, still 2.4, 2.5, 2.3 most likely. So again, the market, at the end of the day, it's still pricing in a situation where when everything will be normalized, inflation will get back to its normal trajectory. Now, can we have a little bit of a revamp, of a bump up in inflationary measurements in the short term? Sure, yeah, I think so. But, everything depends on oil at this point. There is a little bit of a lag in the way higher energy prices are reflected into the actual headline CPI. It's going to pick them up, obviously, but it's not that immediate. And also remember now, we are going to have the inflation print for March, I think in the middle of April, maybe. So not only there is a lag in the impact, there is also a lag in the information which is made available. Now, sure, you can make predictions, you can try to come up with forecasts and whatnot, or again, you can look at real-time data, although they're not officials, third-party independent data. Yeah, sure. So, we are gonna know soon enough what's going on with inflation and all that. But for now, inflation expectations for the longer term are, or looks to be still, well enough anchored, right? To use a technical term, anchored, right? Or anchored, right? I pay so tiny attention to what Powell is saying that I don't even remember the word he spells, right? Oh, by the way, Powell will be out of office pretty soon. So I guess the last FOMC meeting was his last one. So end of an era, right? Okay. Now let's have a look, again, as usual, at the star of the week and, most likely of the month of March. And to be fair, even what could be the month of April, which is oil. Now, WTI in this case, as you can see, was trading in this range, right? So spiked, pulled back, came back up, and starting to work out on this range. And how do you know that's a valid range? Well, first of all, you see it spikes back up into this pocket right here and it rejects. And then you have another pocket to the downside, which would, and it did, provide a little bit of support if ever retested. So now you know, last time found a roof in here, now it's finding a floor in here. You draw your range and then you look at the EQ, the midpoint of the range. Is it respected well enough, aka its price gravitating back toward it and orbitating around it, so mean reverting to it well enough? I think sure. Every time it goes up, comes back to it, goes up, comes back to it, up, back to it. Now it traverses all the way to the other side, and then comes back toward it, comes back toward it. So yeah, I think this is a valid range, which brings me to what happens if we break out of the range. Not a lot of good things, I would say, but that remains to be seen. Usually, when I look for breakout off of the ranges, I would look for a sharp move directionally, right? And then potentially around the retest, right? Getting back to it, holding it, and starting to come back up. So that would be my way. And again, it doesn't have to happen in this time span, right? But that would be the way. I like a rounded retest, right? Because if it is just a spike, right, 1-2 days, and then it collapses back into it, then I would start to classify it as a deviation out of the range, and the mean reverting part of it will be even more violent than what you've seen in here, right? Up until the point we are in the range. I like that you create acceptance outside the range, right? One is a visual component. If there are a lot of candles which are being printed outside of the range, that gives the time to even higher time frame traders to notice, right? As you can see, this is a 2-hour chart, right? But if you have a lot of prints on a 2-hour chart, that also means that on the daily, right, it will start to look like you have 2, 3, 4 candles, daily candles, closed outside the current highs, which gives confidence to the higher time frame traders to actually come in and bid the market, so that even if you're trading lower time frames, now you can try to go and do it with the support, the sustain, the narrative of the position traders out there kind of trading in the same direction, right? Okay, so the door, the bell rang, so I got people at the door asking for something, and it completely destroyed my train of thoughts. But again, I think it was clear enough. The topic was exhausted. We were talking about a rounded retest. Why would you like to see that rather than a sharp move and a quick fade? I guess you got it. So, apologies for the interruption. I know it's probably gonna look bad when everything is put together, but it's just what happens with real life, always getting in the way when you're doing shit, right? But that would be the thing for oil. As for for now, another thing which people are discussing a lot, and it was going around for a few weeks now. And if you remember in the past, we were looking at the divergence in between energy stocks and the actual commodity. And what we were discussing was, well, look, at a point, this gap will be closed. Now, back then, I was thinking, if you remember, and I was wrong, obviously, the facts, proved me wrong in the future, because we got the conflict in Iran, the spike in oil. So at the end of the day, that gap was closed by oil going up and catching up with those higher energy stocks prices. But, for now, what you look at, if we can get rid of a lot of things right here and moving on a weekly chart, so what you see in black, that would be XLE. So essentially this one right here, right? A weekly chart overlapped with the price of oil, or at least the futures, right? So as you can see still, actually it's particularly extended to the upside. and oil, at the very end of the day, catched up. Now, look, there is an interesting narrative because, of course, now, if initially, let's say, when we were in here, a lot of people were maybe a bit skeptical, right? In February, beginning of February, I mean, will this pump actually last? Maybe, maybe not. And then, of course, you have oil catching up to it. So, well, at this point, sure, we need to be long energy stocks. Now, sure, I'm not, again, let's try to be careful with words right here, because otherwise people will think, as was happening with silver and gold and all the rest, I'm not saying, right, that you should go out and sell all your energy stocks right here, right now, next Monday open. What I'm saying, instead, same as I was doing with gold, with the metals, right, is that when things get so exaggerated, it's a good time to take profits. Now, and again, when you say take profits, does it mean sell it all, completely exit the position? No, but just a silly example. Let's say in your portfolio, you want to allocate 5% to energy stocks. Whether you buy the actual ETF on the sector or you buy the individual stocks, let's say your total allocation to the energy sector is 5%. After something like this, obviously, that allocation, it won't be 5%, especially because all the rest actually came down, right? I mean, just this week alone, you check all the other sectors, right? They are down 1%, 2%, 1.6, 2.9, right? So what you need to do, or at least what I would do, okay, it would be, was it 5% initially? Now with this run up, this now probably represents maybe 7, maybe 8%. So what do I need to do is to trim the position down in order to bring it back to target weight. That's it. I'm not saying they're done, they're gonna pull back, that it's over, right? Nobody knows. But it would be just a good risk management type of behavior. And then again, if for some strange reason, and again, it could be the conflict being resolved, it could be one side actually giving in, saying that we are going home, there's nothing more to do, we accomplished the objectives and the goals. Doesn't matter, the narrative. If for some reason then you see this chart right here starting to put in some sort of a top, right? Then at that point, you keep on selling your exposure to those sectors. Right? So, again, it's another one of those just a thought moments, right? Because we have seen in the past that these things, they tend to happen. Now, for instance, this is what happened to oil in a few of the past military conflicts in that region. And as you can see, sure, the spike was there, and you can read all the text if you want. I just want to be focused on the chart below because it's just a recap of what you can read above, right? So, you got your spikes: Gulf War, Iraq War, Libya civil war, Russian Ukraine, and this one right here. Now, sure, after a while, they get resolved, obviously. But what's interesting is to look at what the XLE returns were after we had the peak. So again, we are not there yet because, if you check the price of oil, can you definitely say that this is it and it's not going to go higher, right? At the current moment in time, you would say that maybe it looks like it wants to go higher. So we are not saying that this is a peak, but after you see a peak in the price of oil, the returns for those particular stocks or that particular sectors, as you can see, they're not enticing because of fundamentals at the end of the day, right? Earnings and revenues gets repriced lower. And what you see is that, over time, a lot of those initial profits increase that, that are due to what's going on in the commodity, it's very hard for these companies to actually retain them over time. So stocks will be repriced lower. Then again, this is kind of the same at the end of the day, but a little bit more details on the actual percentages, drawdowns that you've seen in this sector right here. So, sometimes it's better to be safe than sorry. If you had a very good run, it's not bad to bank in some profits, right? So, again, maybe it will take another month. Do you remember? We're discussing metals, right? We're starting to talk about, this rally, it looks a bit suspicious now. And it was the end of December. The actual top came in at the end of January, 1 month later, and it was, I don't know, for silver, it was actually 20% higher. But was it a good period to start taking profits? Yeah, I would say yeah, right? You can't actually nail and time the top, but if you can start to the risk very near the top, whether it's in, percentage or price excursion terms or time terms, it's not bad at the very end of the day. So I would just say pay attention to it if you are involved. And, on average, these are the drawdowns that you could see after an oil peak, right? An exception was in 2003, I guess, getting back to the numbers in here. Yeah, post-Iraq wars. I think because back then there was all this narrative about, peak oil production, there is not enough oil underground. And then we came out with what? With the shale revolution, fracking, and all the rest. So we gained access to much more oil than what we were thinking was available by, the current technology that we got at our disposal back in the days. So, just a thought, but I would pay attention to it. Then there is another controversial theme for me. Now, look, although this is, I think logically it makes sense, right? The conclusion, right? That oil producers are seeing unprecedented profitability. Sure, yeah, why not? But maybe it's just a matter of semantic. I don't know. But when I read these, right? So, okay, these are companies that physically produce, refine, trade, and consume oil from major producers and refiners to shopping firms and industrial users. Fine, all right? And everyone is shorting them, all right? So these short positions have doubled, okay. And, this is where I don't really understand. Maybe it's just me. Write down in the comment if I'm in the comment section if I'm getting it wrong. But by selling future contracts at today's prices, okay, producers are agreeing to sell their future oil at plus $100 per barrel, even if the market price falls by that time they actually have to deliver it. Sure, but then you talk about short positions. I mean, if you showed me a price where a lot of volumes on the buy side are put in right here, right now, then I would say, okay, there are a lot of people which are actually locking in these higher prices for oil, so they're going to be linked and, stuck in honoring that contract and actually make the purchase, even if the price of oil comes down. My first objection would be, yeah, sure, just because I bought a future contract now, does it mean that I necessarily have to hold it till expiration, or can I sell it back? Can I? Right? Because I do remember, not a long time ago, but when it comes down to future contracts, right, I've seen the price of those contracts going negative. I know different dynamics, different situation, pandemic. Sure, physical delivery involved. There are a lot of speculations in it. Sure, but it doesn't mean that the price of futures can come down because a lot of people are selling them. All right. Plus, if you talk about short positions, how do you put up a short position? Because you see, short implies selling, right? But who's selling the futures? By the looks of it, it seems like these producers, right, are actually selling the futures. Are they? Or would expect that to be a market maker or a dealer, right? And, you know, when I short a future, you know, I'm selling it, right? So am I linking myself to actually need to buy the commodity at expiration? I mean, if I'm using margin, I'm actually loaning, right, those future contracts from someone else, and then I'm selling them with the goal of seeing price going lower, being able to buy them back, to returning them back to the original lender and pocketing the spread. So am I really involved in taking delivery of the underlying commodity? So I don't know. I'm gonna, you know, yeah, sure. These guys, the industries, right? The producers, the merchants, they are selling futures. Are they? I don't know if they are selling futures. First of all, short positions means that you are obliged to actually buy the underlying commodity at expirations. No, can I sell it before? No, can I get rid of the contract? So they guarantee revenues. Again, are they? If everyone is selling the contracts and nobody wants them anymore, are they still locking them in? So I think it's a little bit of both. Sure, there might be someone, for sure, which is committed to buy oil now for then at whatever price, because you are scared about running out of oil, sure. But to say that this is going to keep on going indefinitely into the futures and they can only make revenues from here on out, I don't see that. I mean, I don't think that's a given, right? So, you know, probably it's just going to be interesting to monitor it and see what's going on, especially again if we see a price peak in oil. But I don't know. I thought it was controversial. Maybe it's just me being stupid and not understanding. And again, there is a comment section. Tell me if I'm reading wrong or if I'm coming up with legit objections. Look, if you think I'm stupid, just tell me. I don't care about being stupid. If you explain to me how it works, and if there is actually a logic, I'm going to thank you because now I know something I didn't know before. So, you know, I'm all for learning. Just, it doesn't make sense for me. So maybe I don't have enough knowledge yet. So help me out, all right? Ultimately, if you look at the flows, it looks like the crisis, it's not only regional for now, which means that to one side you might say, yeah, sure, the West, if you want to consider the West as, you know, the US or Europe, you know, is shielded for now. It's protected because a lot of flows has been diverted, right? They've seen increased flows coming into Western regions rather than, you know, Asian countries. So the shortage of oil for now is impacting a lot more in Asia rather than the West. But, you know, on the other side, that could also mean that the situation keeps going. Even if we are worried now here in the West, especially Europe, I would say the USA way less than us, Europeans. But if we are scared now, the situation keeps on going badly, then we will really see the crisis manifesting itself. So, you know, a little bit of good things, a little bit of bad things. Like for now, you are in a lucky spot, but it is a lucky spot which could be taken away very soon, right? So again, one more thing to pay attention to. Now that would be pretty much enough for oil, unless you do want to check the Brent, which again, if you compare it to WTI, what you see in the Brent, well, basically what you see is that it's a lot more bullish than WTI, obviously, right? But if you look at this, the spread, the prompt spread, we were looking at it 2 weeks ago. Sure, the spread was trying to come down and now it's going up again. So we still have backwardation. So, you know, not a positive for the actual price of the underlying commodities for now. So, that would be it. And again, if you think things are, at the peak and it cannot go worse than these, I would suggest you to think again, even if you don't like to think about it. But there are a lot of scenarios where things could actually be worse than these, right? So with that, let's have the brief pause as usual, and then we will come back wrapping up the video talking about the stock market. Talking about the stock market, let's have a look at the different sectors first. So you see technology, XLK, down massively, obviously, right? Then you see instead energy. We were looking at this chart when we were discussing oil, up massively, all right? Then you got what? Materials. They bounced this week off of a good level. If you draw an horizontal line in here, you see that was a pretty good level for at least a bounce, all things considered. Look at all these highs right here, right? Trading pretty technically, to be fair. Then what? Utilities, good bounce. So, that's right. Consumer staples, stable, though, stable this week, but at the end of the day, they were coming off of a very sharp pullback. So, wouldn't be particularly optimistic on those. Then you got consumer discretionary down, of course. And you might say, why? Well, if you think about inflation expectations going up, what do you think is going to happen to the discretionary spending? It will be diverted to things that you actually need, like keeping the lights on, putting food on the table, so less discretionary things. You start spending less on what you want, and you keep on spending more on what you need. So that the usual difference in between wants and needs, right? Then what we got, communication down massively. I think, look, where is, well, Google, Meta, it tells you tech, but I think they hold a spot, at least Meta, in the communication. But, bottom line, there was a resolution on a lawsuit this week. I think it was on Thursday, which was seen involved Google and Meta. So basically, they were accused of not protecting the users, or trying, to set up the algorithms to just farm engagement. Now, as for the case itself, can you sue a multinational or a big tech just because you argue that using that social media caused you to be depressed, to feel anger and anxiety, and not being able to do shit with your life? Are we getting there? All right. Well, look, you know what? I'm starting to get old, and I'm having troubles, right, to digest milk. Could you point me out to a multinational that I could sue because I can't digest milk anymore? No, come on, don't get me started. It looks like we can just blame someone else for our own limitations and failures. Now, sure, are these people trying to farm engagement? Yeah, that's their business model. But, would you sue a casino because it is enticing you into gambling? Fuck's sake, don't go to the casino, right? It's just, instead of spending the entirety of your day with your head down on a fucking smartphone, just start to live in the real life. There are a lot of things to do in the real world, right? And then again, is it Zuckerberg fault? Mark Zuckerberg fault if you don't know what to do with your life? No, but again, on the other hand, I must agree with the fact that there are mechanisms which you might consider quote unquote predatory when it comes down to engagement farming. So who's right, who's wrong? I don't know. The bottom line for us, beside my personal opinions, right, it's that sure, the stocks were punished a lot for that lawsuit. And as you can see, Google this week and Meta this week, nose diving, right? So that could be something which impacted. Then what you got, we were looking at utilities, staples. Oh, okay, communication. So then what? Financials down again. It could be a little bit of that private credit issue, which is right now waning on the financial sector. But overall, I mean, I think at the very end of the day, financials will be all right on the other side of things, right? Then what? Healthcare down, but immediately had a good run up. So we are just pulling back at the very end of the day. Industrial, the industrial sector, as reflected in the Dow and, to some degree in the Russell 2000, they are holding up relatively better compared to the S&P benchmark and the Nasdaq, so the tech sector. So I'm not surprised to see the industrial sector, which again, it went way ahead of itself, obviously, but, we are just pulling back to much more normal levels and to the bulk of volumes which were built up, right? And finally, real estate, which complete reversion, right? Look at this range, right? Attempted to break out, back in it, fully mean reverting to the other side of the range. So I think energy up, therefore yields up, therefore mortgage rates up. Is it good? Is it convenient to sell your house where maybe you are locked in a mortgage at 3% to buy a new house and locking yourself in a mortgage which would most likely be around 6.5%? Is it good? Or at least, does it create an incentive structure to do so, and therefore keep on, keeping the machine spinning in the real estate market, aka houses being bought and sold, right? So actual transactions. Now, I think it leads more to a freeze in the real estate market. So it might be one of the reasons why we are seeing this sector being, again, since the beginning of March, actually. So, the war, oil, yield, it's impacting that sector as well. So that would be if you look at the sectors. Now, if we just look at the index or indices instead, what we see is that, again, same pattern. And again, now I'm going to tell you the joke from the beginning of the video, right? NACHO, NACHO, and all the rest. It's not mine. I just read it online. So first, I heard it on, I think it was Craig Shapiro, right? He said, well, tacos, they look fantastic at the beginning of the week, but then you find out that they are hard to digest. And at the end of the week, you end up puking them, right? So, taco. And then now they are talking about nacho. And that came out, I mean, I don't know where it came out. I read it from Jim Bianco. But basically, nacho is the new acronym. If taco was Trump always chickens out, and therefore, it makes such huge threats, and then it doesn't live up to them, and the market immediately reprises to the upside because there's no threat, right? Yeah, we know Trump likes to make this threat, but then it doesn't go through. All right, so we can pump again, no risk. Now we got nacho, which is basically a reference to the war, the conflict in Iran currently. Basically stands for, what was that? Not actually changing Hormuz opening. Nacho. So whatever Trump says, right? And he usually does it before the market opened on Sunday, or he tries to do it at the end of the week before the market closed, so that he tries to not generate a very bearish close. But again, at the end of the day, these things, you can manipulate market for so long, but at a point they will just stop believing you, right? So what do you see again? Weekly open, up we go, Monday, Tuesday, all across the board. Then getting into Thursday, reversal. Now again, these reversal right here, you might add on top of it what went on with Google, Meta, lawsuit, and all the rest. Big stocks in the index overall, which might have been contributed to bring the index down at this pace, all right? But quite honestly, if you zoom back, look at the previous weekly pattern. You can read, this level here, weekly open. So the week opens up we go, Monday, Tuesday, Wednesday, we reverse, Thursday, down, Friday, down. What about the previous week? So we are getting back to the beginning of March. Sure, gap down, but then immediately when we get into the US market open, which is kind of around here, right? Up we go. So Monday, at the end of the day, up. Tuesday, up. Wednesday, starting to create what? Broken record. What was that? Top, a floor, which is broken, tested back into, down we go. And it's basically pretty much evident in the NASDAQ, a bit more sloppy in the S&P, but, same pattern. And again, Thursday and Friday down. So at the very end of the day, you see the market being up at the beginning of the week, and then comes Thursday, Friday, we're down. So here's the joke in between, tacos being delicious at the very end of the week and then difficult to digest at the end, and the NACHO. So whatever you say and do, if it doesn't actually change the fact that the Strait of Hormuz is still closed, the market will believe you won, then twice, third time, you know what? No, nothing is actually changing. So why should we keep believing what the president is saying? Especially if the other part, it's continuously negating that. So at this point, we don't trust both parties. We don't trust neither of those. All we know is the fact that the strait, it's still closed. Who cares who's right? Who cares who's going to win or how and when? What we know now is that the strait is closed. So, that is a little bit of that. Now, as you can see in here, if you zoom out on a daily time frame, I'll still say that there is room to come down even more. So for the S&P, I would say 6,100, but most likely, if things really go sour, 5,900, or even getting back into here. I would just say, 5,800 would be where I put, kind of the line in the sand from these being just a pullback, which, by the way, it would be a pullback of what? From the highs, let's say we get in the middle of this region, 15%. So we are already in the upper boundaries of what a normal correction looks like in a normal year, right? Again, we have been looking at these, we have been saying when we were looking at seasonality that more often than not, election years, they see the mid part of the year being particularly weak, all right? And then, depending on how the elections actually go, the end of the year, you might see a bit of a rebound. This year right now, coincidentally, we got midterm year plus conflict where in the Middle East, energy spike. So situation, it's a bit much, I don't know, a bit more, it is complicated anyway. So that's what the market, it's starting to sniff now. It started really when we were discussing, does it look like around the top at this point, right? And of course it was, and it's now being confirmed, right? So the point now is to try to come up with targets to the downside. Again, I would say at the end of the day, 15%, something in between 10 and 15%. Could end up being 12, 13. And again, with the big caveat that this thing in the Middle East is not going to keep going for another month or two, right? But I still think we have room to the downside. Yes, NASDAQ, NASDAQ 22,200 or 21,600 maybe. I know it's a huge spread with 400 points, but if I had to pick a region, I would pick this one right here, right? Anything in between 22,200 and 21,800, kind of like that. But at least for a bounce. I'm not saying this is going to be the ultimate low, but I would expect initial support down there. And the others are pretty much the same. I mean, if you look at the line, I mean, for the Dow, would you put an additional line in here, which seems to be pretty much respected, and it should be at it right now, although front run kind of ahead of times, bounce, and then down we go again. In the context where you see the Dow and the Russell, at the end of the day, acting a bit stronger, as in, whether you believe it or not, and I didn't believe that initially. Sure, then, you need to assess for things changing around, the conflict in Iran, sure. But it looks like the domestic economy, it's at least a reflection of the expectations reflected in the markets on the domestic economy. So the participants in the domestic economy are a little bit more rosy than what people see for the S&P and the NASDAQ. The S&P, if you just think about the fact that 40%, I think it was 38 to be exact, but roughly 40% of S&P companies' revenues come from abroad. I mean, if abroad is fucked because of the energy spike, does it really matter if you are a bit more protected from it? Your companies will see revenues going down, and, lower revenues, lower earnings. You think about PE ratio. If the E in the ratio comes down, right, the P will need to adjust down, obviously. So I think it's a little bit of that fundamentally. For now, I would be very cautious on stocks, because even the retail trader has shifted from buying the dip to sell the rips, right? So precarious situation here. Now, let's have a look at these, because we were talking last week about the 200 days moving average in purple in here. So I got a few slides. I'm not going to read them all, but you can just post a video and look at the data for yourself. But it is just a little bit of a recap of what happened when the market breaks through the 200 days moving average, all right? The bottom line is, sometimes you have temporary breaks or fake out, right? Sometimes you have sustained breaks, right? So here you see the data for when you have a sustained break, I think, in here. Yeah, sure. So if you want to read it, go ahead and do it. Here, the data for when you have just, fake out. So the market briefly dips below the 200 days, and then it can come back above it quickly enough, relatively quickly, and resume the bullish trend it was in, right? So a bunch of different data. Will it play out exactly like that this time around? Who knows? But data are data. So here they're putting together, all right, a little bit of they're looking at the break of the 200 days, and they're looking at other indicators, right, such as the slope of the moving average itself, the weekly MACD, so the posture of the weekly MACD, the RSI value. Here they're looking at the sentiment, all right. Here they're looking at the breadth, all right. So depends on how much of these other triggers are present or not, they can establish if it's going to be a sustained break or just a whipsaw, right? And it looks like for now we are in the caution situation where we got not just one or two, but we got maybe three. So we should be caution at this point. And again, on average, this is the representation in between the sustain versus brief breaks and what happened after 1 month, 3 months, 6 months, 9 months, and all the rest, right? Now, the argument might be, and I know this is old story, but every time we get back to it one way or the other, look, there are a lot of money on the sideline. So at a point, this market will be cheap enough that all this money, and look, we are talking about a bit more of 8 trillions in money market funds, right? At a point, this money will be deployed in order to, buy the dip, buying things for cheap, right? I already discussed this dynamic in the past. I don't think it holds a lot of water at the very end of the day, especially when you take a look at this number, 8 trillions. And I know, there are approximations, there are adjustments, a lot of mathematical quirks. But when you consider these, corporate balance sheets and the cash which is sitting in them, and you see that it's roughly at the same level, 8 trillions. Look, the problem is corporations, they got their money in money market funds just to not seeing them, losing against inflation. But if you are a corporation, would you think that all those money, you don't need to, buy the things you need for your operations, paying your payrolls, right? Or using them as a buffer, right? So I don't see the mathematic or, the logic by which a lot of money on the sidelines, they will need to buy stocks. But look, a corporation doesn't need to buy stock. They got this money, the reserves. It could be for rainy days. It could be because, those are profits. They accumulate the profits and then they know they have to, they got payrolls, or maybe they know they have debt to be paid down. So you know what? I'm going to put my revenues in a money market fund so they don't lose against inflation. Actually, if I have debt that I took out years ago when rates were still below 2%, now I can park my revenues in a money market funds, right? Getting 3.5, 4% year on year as a yield. So, I'm completely nullifying my interest burden on that long-term debt I was, dealing with. Why would I take this money out of here where I know they're giving me a free return, which completely offset my interest rate costs on the debt that I have, to put all this money in a risk-on asset where I don't know whether I'm going to lose money or win money, or, from a risk perspective for these guys, it doesn't make any fucking sense. So the entire thing about money on the sideline, once again, I don't trust that and I don't believe that. Because that's what I would think about, that's what I would do if I was a CFO in one of these corporations which are holding a lot of money or cash on their balance sheets, right? Risk control. I know I got expenses in the futures that are quantifiable, right? In the amount, in the time they will be due. So what's better for me? Trying to gamble and buying the dip in the stock market, or keeping when they are, where they're giving me a free return? So, that's another thing. Lastly, yeah, sure, credit crisis, private credit, is it as bad? Here another post, which, it tells you that the sector is expanding, but, just look at that. Is it bad? Yeah, sure, it looks bad. Yeah, who knows how it's going to end up? But will it lead to another financial Armageddon like in '08? I mean, look, the sector has grown, obviously, but, in 2007, 2008, residential mortgages amounted at about 45% of credit. So, the ratio in between what we are looking at now in the private credit market, it's not the same. So the impact shouldn't be the same. Although, again, one thing is the actual math, another might be the perception. And again, look, if you think about what's going on now with all these funds from BlackRock to Blackstone to Blue Owl, and now Apollo and all the rest, look, the thing is, when you buy into a private equity, you're getting a lot of return because you are being paid a liquidity premium. You lend money to people which then lend that money to long-term projects, right? So it's obvious that the capital is locked in because those are long-term loans that they are making, and they cannot, giving back you the money after 1 year if they committed them for 7-8 years. The liquidity must be locked in. And although I know it might sound scary at the current moment in time, but the thing is, when you sign up those contracts, you know what you're signing up for. You know that that liquidity won't be available to you, which is why you're collecting a massive premium on it. All right? So, I think a lot of the panic that we are seeing right now in the private credit, I mean, is there an issue? Did these guys basically extended loans to everyone, although the projects they are financing are not worth those finance? Maybe, possibly. Are we in a bubble? Maybe, possibly. Is the software as service sector under pressure and probably will be disrupted by AI? It could be. But at the same time, you should look at the other side of the coin and saying that maybe a lot of people are forcing these funds into, suspending redemptions out of panic and because maybe they got expectations which are not met now, or they didn't fully comprehend what they were signing up for. They were expecting 13, 14, 15% returns year over year and capital to be available for withdrawal whenever they wanted. It's not the way it works, right? So now you can't cry wolf just because you put yourself in a situation and you knew from scratch what type of situation there was. So on the other side, they say these funds, they are preventing you from withdrawal because if you keep on doing that, you will force them to sell at a loss, impacting all the other investors. And look, I don't doubt that on those balance sheets, there must be some loan which is actually pretty cool. And if you just stay in, if you don't panic out, in another 3, 4, 5 years, everything will go away and you will make a bunch of money on it. But the problem, again, this is why I talk about perception. At a point, it doesn't matter. The math can actually compete with human psychology when you got panic spreading out. So again, that's another thing, right? And with that, we pretty much close down the recap for the week. We'll see how things are going to shape out. Again, keep on monitoring what's going to happen. I think the market is a bit extended to the downside, so I wouldn't discard again. Although we get back into the same dilemma. Up Monday, Tuesday, then down 3 times in a row. Would you bet on a 4th time? Maybe, but it sounds harder and harder. So I would just put it this way. Even if we see a bounce opening up the week, at this point, you shouldn't trust it, right? So all the rest, I think, is out of our control, like the war, the conflict, oil, yeah? So we can just play defensive now. Plus, next week we're going to have NFP, unemployment data, ISM manufacturing PMI, so retail sales, ADP employment change. I think we are going to have JOLTS. Yeah. So labor market data next week to add a little bit of volatility. It wasn't spicy enough, right? So pay attention, be nimble, be sharp, and of course, up until that point, be nice and be cool. Neil's out.
Mm-hmm. Mm-hmm. Mm-hmm.